Hi, I'm Rusty Dornan from the Kaufman Fellows Academy, and I'm honored to present for his final hangout of the course, Brad Feld, the co-author and instructor, of course, of Venture Deals. Welcome, Brad. We're here today to talk mostly about getting acquired, but I have a feeling you're going to get a lot of different questions on several different topics today. You talk about in the lectures, that it's important to develop relationships with potential acquirers long before you might become attractive to them. How do you do that?
A couple of different ways. One is, when you start your company and you start to develop your company, one of the exercises that I encourage people to go through is to come up with your list, maybe your top 10 list of natural acquirers, companies who are most likely at some point in your business's life to be interested in acquiring you. Now, these natural acquirers are not necessarily companies that are proactively interested in you, but there's some reason why your company might fit with theirs. And once you've figured out who these companies are, start to develop real business relationships with them. Try to figure out whether they have partner programs. Use tools like LinkedIn in your existing network to try to get access to senior executives in the company in ways that could be helpful to their company. One of the things that I find startups can do very effectively is, because they're so nimble, they often can do things that are helpful to a much larger company as a way of introduction. And so rather than just show up and say, hi, here I am, pay attention to me, do something that helps promote the larger company, that integrates what you're doing into their universe or that works with their technology, and just use it to start to develop a relationship without necessarily a particular ask on your part.
Okay, we've already got some questions coming in. Assuming that my startup is expected to go through 3 rounds, ABC, of capital raising before an acquisition, and there was an initial seed round as well, would you suggest I create a cap table for those stages in advance so as to get a better view?
Yeah, I think that it's useful to model out what you think the cap table is going to look like through multiple rounds of financing. There's a CFO at a company I was an investor in once who essentially had, when they started the company, he was one of the co-founders, he created the life cycle funding expectation for the business. It was a company that ultimately went public, and he would, after every round, he would refresh it and reforecast what was happening. You can kind of do the math in an easy way, just guesstimating what dilution would be for various types of rounds. So it's not necessarily the case that you have to do a super comprehensive cap table, but it's good to have some sense as to what it's going to look like based on how much money you think you're going to have to raise, knowing that the valuations and the amount that you're going to raise are going to vary dramatically from whatever you forecast on day one, but it's at least worth having a hypothesis.
Okay. How does the financing terms affect a later acquisition?
I would say generally financing terms, especially early on, aren't correlated with the acquisition activity, right? The way that your terms impact the acquisition is who has what ownership, and are there any special terms like participating preferred that give additional economics to investors in an acquisition. Occasionally you'll get not occasionally, I would say in some instances, I won't, when I say occasionally, it means it doesn't happen very often. In some instances, you end up in the situation where, based on the capitalization of the company, liquidation preference is going to matter a lot. Let's say that you're a company that's raised, $10 million, and the acquisition on the table is for, $12 million. The acquirer is going to want to make sure that a meaningful amount of the consideration goes to the founders and the employees that are staying with the company. So you get into these situations where, there are things like carve-outs or renegotiation of retention. You also have vesting dynamics a lot with acquisitions. It used to be the case that the mathematics of it were that if the company was being bought for, let's say, $100 million, 90 million of it would go to the shareholders, which include, by the way, the option holders and the employees and the founders, so the cap table. and then 10 million of it, 10% of the deal about, might be for retention that was paid out over a 2 or 3 year period to the key employees of the company, in addition to whatever option packages the acquirer would give. More recently, what's happened is that 100 million still is the number, but instead some of the employees revest their stock. So let's say you fully vested your stock as a founder, you might get 75% of your consideration and then have to revest 25% of your consideration over the next 2 years. So all of these things kind of get tangled up in the negotiation around the exit. Sometimes it matters what it looks like at the beginning, but I would encourage people not to worry too much about that when they're starting the company and raising the first couple of rounds of capital, because what's more important is that you have sort of a clean cap table and balance between the investors and the entrepreneurs and are comfortable with what the structure is. If you get to the place where you have an acquisition, you recognize that all that stuff is a negotiation. You'll have to work through that.
Okay. I want my company to be acquired by Google. Is this an appropriate goal for entrepreneurs?
No, it's a totally stupid goal. I hear this a lot. You know, we're building this company to be bought by company X. And, you know, there's a cliche in the venture business is that companies are bought, not sold. So the cliche is useful because what it basically says is have a vision, go after that vision, build something really important, build something that works and is meaningful. And if you do that, you'll have plenty of options in the future for people to acquire your company. You know, if what you want is to work at Google, then go get a job at Google. If you're focused on starting your company, you'll find your only acquirer, right? If you know, you say, I want my company to be acquired by Google, but let's say that Facebook showed up and Facebook offered you twice as much money as Google offered you. Or let's say Google wasn't interested in buying your company, but Facebook was. You'd probably sell it to Facebook if the deal was interesting enough. So take that, and instead of just Google and Facebook, there's 100 companies or more than 100 companies that are in that population that could acquire your company. Why focus on a single company as the outcome? And instead focus on building something that works. It's a successful business, and then you'll have lots of options.
You know, a lot of folks maybe do research about who's in their industry that might be good as a potential acquirer. But what do you think about trying to be creative and not thinking of the usual suspects, kind of going outside of the box to be, in terms of thinking of somebody who might buy you? I mean, is that worth it, or should you just stick to researching, you know, what's in your knitting?
No, I think you should be creative. This is, you know, the exercise I described earlier of the top 10 natural acquirers. I use the phrase natural definitionally, right? Natural means ones that are sort of most logical, you fit with their strategy, your products or service that you're developing fits with their approach and their model. But then, you know, there's plenty of acquisitions that are out of the blue, right? You know, both Google and Facebook recently bought companies that were working on drone technologies. Obviously, Facebook just bought Oculus Rift, which was a virtual reality hardware product. You know, things surprise everybody all the time, and you don't really know exactly what that long-term goal of that company is. There's a period of time where Salesforce, you know, .com was very focused on, you know, they didn't do too many acquisitions, but when they did acquisitions, they were tended to be companies that were around CRM and sales management, and then all of a sudden they started buying companies like Heroku and Database.com and a few others, and before you knew it, you know, Salesforce had bought a bunch of cloud infrastructure companies, and then one day they started buying companies that were doing marketing-related things like Buddy Media and others. So the strategies of these companies as acquirers evolve over time, and it's hard as an entrepreneur to necessarily anticipate all those things. So, you know, it's worth, again, developing those relationships with companies that you think you potentially have some overlap with. And to the extent that there's a company in your universe that you have friends at or you have some kind of relationship with, it's not an obvious acquirer, but your sense is there might be something. Being open about that and being proactive about developing the relationship is definitely useful.
Okay, is there a rule of thumb of when a founder and or lead VC should hang in for an IPO over a lucrative acquisition opportunity? At what point do the investors or the board push the founders to one direction or the other?
It varies a lot based on a couple of factors. One is the health of the IPO market, and right now, until about a couple of weeks ago, we had a pretty healthy IPO market after a number of years where there was a very unhealthy IPO market for tech companies. And I don't have a prediction as to the long-term health of the IPO market. All I know is it's going to be a cycle. So sometimes it's more healthy than others, and other times it's not healthy at all. But if you assume that that's one factor. If there's no IPO market, obviously your exit's going to be most likely an acquisition. If there's a healthy IPO market, then you have to make a choice. Another factor is the investor. There are some investors who are very obsessed with this idea of having long-term public companies and building companies that go through IPO. And then there are other investors who are relaxed about it and kind of want to do what the entrepreneur wants to do. And then there are some investors who actually would much rather have the companies be acquired than go public. So it varies a lot on your investors, and you can usually get a sense of those investors by the other companies in their world, how many companies they've got that have gone public, how they tend to behave and interact, and recognize that it's not a static thing. If you're a fast-growing company and you reach some scale, say $50 million in revenue, and you're growing, 30 to 50% a year or more, you probably have the choice. But if you're a $50 million company and you're only growing 10% a year, IPO market's probably not a particularly good option for you. So it's more likely that you get acquired in that scenario. Obviously, if you're a much smaller company and you get an offer, let's say you're a $10 or $20 million business or even smaller, and you get a big offer for the company, you're not going to be big enough to go public, so that offer is going to be what matters. So message, and I realize in the last 15 minutes I've said this multiple times, it varies. There's not an absolute answer, and I think as an entrepreneur, searching for an absolute answer will be frustrating. I think you have to be flexible, you have to recognize that things move around and that there isn't this sort of notion of an absolute.
Okay. How important is it for entrepreneurs to be thinking about their employees in an acquisition? I mean, how much ahead of time should they be thinking about how they're going to handle it?
I think I personally, as an investor, but an investor, who's been involved in a number of companies as an entrepreneur, I think it's very important. And I learned this from my first company. So my first company, we had 20-something employees and got bought for a couple $1 million. This is in 1993, and there were only 3 shareholders: myself, my partner, and my dad. So the other 20 employees at the company, none of them got any economics in the deal when we sold the company. Now that was okay. They had nice salaries. They got some salary increases. They got some stock options in the company that bought us. But it was a celebratory moment for my partner and I, and it felt a little bit different for everybody else in the company. I think everybody was mellow, and we were, a good company, so it worked. But it always stuck with me that the employees didn't get anything out of the deal. So I think it's important to be thinking about that from the beginning and thinking about how you want people to feel the day after the deal. So the day after the deal closes, most acquirers are going to be buying your company and hoping that people will stick around. They're not buying the company as a tech company typically to shut the company down or to just buy the product and not keep the people. There are some cases where that happens, but the vast majority of acquisitions, the acquirer cares deeply about the people in the company. That's the driver of a lot of the reasons they're buying it. So you really want to be in a place where employees that have been there for a number of years and have really contributed to the success of the company share at some level in the reward. I think that builds both a lot of loyalty going forward post-acquisition, but also is just a good karma thing to do in the context of building a business, and likely you'll build a stronger business if you have this mentality and mindset of sharing some of the ownership with your employees.
If a relatively strong founding team has an idea and they believe that it could be $1 billion plus opportunity and need to raise seed round to build the product but can't find strong connections to a VC for an intro, what are the options for the founders?
Well, friends, family, and angels are your options. And depending on the amount of money you're trying to raise, a seed round of less than $1 million, you probably don't want to bother with VCs anyway. Unless you're targeting very specific seed-oriented venture capital firms, of which there are some. Raising $250,000 or $500,000 or something sort of in that range, don't waste your time with VCs. Focus on angel investors, focus on people that you already know that make investments in technology companies. Focus on 1 or 2 degrees of separation from family members and from friends that are people that are willing to support you at the very early stages.
Also, I had this actually in my own set of questions too, but any strategies from the founder side early on to address the potential conflict of interest in later M&A events?
The best way to deal with that is to have a very simplistic set of terms. Right? When you think about, there's 2 different things that came up. One is conflict of interest and the other is conflict. So conflict comes up from people having different points of view about whether to sell or not to sell and who's getting what and what that looks like in terms of the transaction. And making sure that you understand each deal that you do and what the economic terms of each deal that you do is very, very important. That's separate from conflict of interest. Conflict of interest might be that you have a board member or an investor who's also an investor in the company that's acquiring yours. And there's a spectrum there. When the investor crosses over between 2 companies and has an investment in both companies, in some places that can be extremely helpful because that can facilitate a more serious conversation. It can help cut through some of the nonsense of a typical transaction. On the other side, a lot of people are very overwrought is probably the best word about those conflicts. So you'll see situations, for example, especially between 2 private companies, where the largest investor in both companies might be the same person, and the 2 companies are talking about merging, and suddenly everybody, including the lawyers, get anxious about that person or that investor being involved on both sides of the transaction. So they basically say you have to recuse yourself from this whole thing, even though you're the largest investor in what's going on. So my general sense is if people are open about the conflicts, if you follow things from a purely legalistic perspective in terms of deal process, you have independent voices at the table, you'll get through that stuff. I'm not a big fan of the, okay, you have a conflict, so now go away and hide in the corner until this is done and we'll call you when we figured out what happens. But a lot of people feel more comfortable with that or some version of that, and frankly, you sort of roll with what the board and what the overall group decides is the process.
What are some do's and don'ts around no-shop clauses? Do first-time entrepreneurs take them seriously enough, and how seriously should they be taking them?
So I think you should take no-shop in the context of an M&A transaction very seriously. I always do as an investor. I think that when you sign the LOI to be acquired, you're most likely signing a no-shop. It's very unusual for you not to. And that no-shop typically will go somewhere between 30 and 60 days with a renewal, usually on the part of the acquirer of another 15 days. So, typical period of time to get a deal done is 45 days to 60 days, somewhere in there. Once you've signed the LOI, you should be signing the LOI with the idea that you're going to get the deal done. And you want the acquirer to sign the LOI with the idea that they're going to get the deal done. And the no-shop is part of that commitment. That's the formal part of that commitment. I've been in situations, when I've been under a no-shop where there's been inbound from other potential acquirers. Most no-shops have some sort of notification right. So if you get an inbound, you have to tell the potential acquirer that somebody else has reached out to you. Just play by the rules. Don't nod. There's no health in that. There's no good outcome there. If you're not comfortable tying yourself up because you don't think the acquirer is serious and they're just trying to get you to sign a piece of paper with a no-shop so they can spend more time deciding whether they want to do the deal or not, don't sign the LOI. So lots of situations in our world where somebody's expressed interest and puts a term sheet down and tries to get a term sheet signed with the no-shop, but they've got so many outs, so many ways to get out of the deal, and it's clear to us that they're not committed to go forward with the deal yet. And in those situations, we just say, look, let's keep talking, keep doing your diligence. Come to us when you're ready to get this deal done, and then we'll sign an LOI and we'll sign it for the no-shop.
Well, you usually know which companies might use your technology, your people, that sort of thing. And pre-no-shop, obviously, what's the best way to start multiple and maybe competitive conversations with potential buyers?
Well, there's a couple of ways. One is the way I described previously, which is essentially the dynamics where you've already built these relationships. So when somebody expresses some interest in you, you can quickly call a handful of other firms. So that's one approach. Another approach, if you're an aggressive entrepreneur that's comfortable picking up the phone and calling some folks, is you can call some people that you think might be on that natural acquirer list, without having to necessarily have that previous relationship with them, or use your network to try to get to some of those folks. Another approach is to hire an investment banker, depending on the size of the deal, especially if the deal is a larger one. Investment bankers can often be very helpful in generating competition on the buy side in terms of getting you in front of other potential acquirers when things spin up. The thing I would encourage people not to do is overplay their hand. If you only have one company that's really working on buying your company, to give them a sense that there's lots of other people involved in a direct way often will backfire on you. I have a pretty simple rule of thumb, which is I'll never lie in a negotiation. I believe that once you have been caught in a lie in a negotiation one time, you lose all your credibility in any negotiation with anyone who ever has heard that you've lied in a negotiation. I've been on the receiving end of lots of lies, especially from people in companies, where they're, I would say that the two places you see them the most are from corp dev people and from lawyers representing an acquirer. And people will say, wait, I didn't lie, I just didn't tell the whole truth, or I misrepresented the situation a little bit, or it was a white lie, or I just didn't really sort of describe the whole it's bullshit. You get these things that are clearly the person has told you something that is not true, you catch them in it. If you confront them with it and they don't own it as the acquirer, then it's very hard to negotiate with that person. It's very hard to negotiate with somebody who retrades you. In other words, they say, here's what we're going to do, and then 2 weeks later they say, well, we're changing that to this now. If they can't make it, now, sometimes things change, but if the explanation is because we could, or because we just decided to, or because you were in a blah 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 where blah 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 is kind of noise, doesn't have any correlation to reality. That's a difficult situation to be in, and acquirers who do lie or who are deceitful in their deal process tend to behave that way. Interestingly, your lawyer, if it's an experienced deal lawyer, will tend to know the deal tone or the deal style of the acquirer. They'll probably have worked and done deals with that firm before, so they'll know going into it what you should expect. That's true of investment bankers as well. And it's often the individual person or people you're dealing with in the acquirer, not necessarily representative of the acquirer. So you may have somebody in a very large company on the business side who's amazing to work with, and the deal starts to come together, and all of a sudden you get tossed into the legal and corp dev process, and the legal and corp dev people are miserable to deal with. That happens, and being ready for that as an entrepreneur is important, because sometimes you find yourself in that situation. Doesn't mean you can't get to a good outcome, but it means that the process may be harder than it needs to be. The tactics that you're going to use may be different, and you're going to have to be ready for some things that are unpleasant.
Okay, well, today's T-shirt has brought up a question from a student. What can we learn from Twitter's acquisition of Gnip?
Gnip and Twitter is a good example of a natural deal. Gnip essentially as a company was started about 6 years ago, and I think 4 years ago they signed a deal with Twitter. They were one of a couple of companies that had access to Twitter's fire hose, and Gnip is by far the market leader in taking Twitter data and making it available in a consumable form for other companies to then do things with that data in terms of social media monitoring, data analysis, things like that. They had a very close relationship over the years, the two companies. There came a point in time at the end of last year, beginning of this year, where some conversations began, which culminated in Twitter buying Gnip. Gnip's based in Boulder. It's a 90-person company. It's now a very large Twitter office, and there's an expectation, I think, on both sides that it'll be a very powerful and fruitful experience for both. In terms of sort of all the sort of macro lessons learned. It's the kind of stuff that happens all the time. We were the largest investor in Gnip. They didn't raise very much money. It was a company that was very efficient with the capital that they'd raised. And as a result, there was a lot of flexibility on the part of the founders and the investors in a transaction in terms of how it was structured and what it looked like, because you didn't have a ton of money that then required a certain type of deal to result in getting to a good place. I think it's also something, I mean, I can't speak to the public market dynamics of it, but from a long-term strategy perspective, I think is a very powerful way for Twitter to build another revenue stream, which they have, but has been growing, meaningfully, but should accelerate with the acquisition. So this, you come back to the beginning of the conversation, like the pieces fit together really nicely. It was a natural acquirer. The two companies had very tight relationships. The senior leadership at Gnip had lots and lots of interactions at different levels with people at Twitter and vice versa. There was a lot of respect between the two organizations. So ultimately, the fit was really nice and straightforward. And I didn't wear the shirt with any. I didn't realize I had this today, so I didn't wear the shirt with any foreshadowing in mind.
That's okay. I saw the question, and it took me about 5 minutes before I realized what T-shirt you had on. So it took me a while. In cultivating relationships with potential acquisition partners, what level and background does one go for? Their legal department, financial, executives?
I think you should focus on people on the business side. Most deals between companies come together between either people on the business side or people on the technical side, and it happens at the CEO level or a CXO or VP level. If it's a large company, it happens from a product manager within a product group, and sort of the legal and corp dev and finance sides of the big company tend to get involved to help manage the acquisition. They're not the driver of it. There's a lot of inbound into corporate development organizations, and these large companies tend to have corporate development groups that capture that inbound. Many of them, I'd say the corporate development's job with that inbound is to essentially pay attention to it, but try to not have anything happen unless it's an obvious no-brainer. So it's a way of sort of keeping the company shielded from all the random stuff that comes in, and every now and then a gem shows up. So it's not a particularly high signal way to make progress. The much more high signal way to make progress with a large company that would be a potential acquirer is to have a business relationship with them, to have your team, your people on your executive team or people on your product team actually working with a company that's potentially an acquirer. So at some point they come up and say, oh, well, maybe we should think about acquiring you guys.
Okay. Follow up on the question on the billion-dollar opportunity. If you need to raise $1.5 million from angels and need to raise tens of millions in later rounds, what should be a comfortable range to give up in equity for angel seed round?
Well, $1.5 million in the seed round, you're probably going to give up somewhere between 20 and 33%. I would say that most, independent of the amount of money that you raise, most rounds tend to be 20 to 33% dilution. It's not a rule of thumb. It's just kind of what ends up happening based on what you're taking. So if you think about $1.5 million, 20% dilution, would mean that your post-money valuation is about $6 million. And a 33% dilution would mean that your post-money valuation is about $4.5 million. So, a post-money valuation for a seed round of $4.5 to $6 million isn't crazy. It's not on the high side, it's not on the low side. Could you be in a situation where you raise $1.5 million and only give up 15% of the company? Sure. Could you be in that situation where you gave up 40% of the company? Yes. But it's kind of that dynamic that you sort of zone out on. I would suggest that it really has nothing to do with how much you need to raise in the next rounds. It's more to do with raising the least amount of money that you need to raise right now to get to the next round. And I think the mistake a lot of entrepreneurs make is that they raise too much money at too low a valuation up front. All of a sudden the money's available and you just keep scooping it up. And I'll give an example. I'm an investor in a company called Cato. It's cato.im in case anybody's interested. Went through Techstars last year, and we put a term sheet down to do $1.5 million round at a $3 million pre-money valuation, so $4.5 million valuation. And we said, we'll do $1 million of it, and you can have your mentors and other angel investors that want to participate that know the company do the other $500,000, and we'll take the whole $1.5 million, but we'll reserve up to $500,000 for anybody else. And within about 48 hours, they had demand for about $3 million to invest in the company. And the entrepreneur had to make a choice. I said, look, I'm not willing to invest at a higher price. If you want to raise money from the other people and not us, that's your choice. If you want to raise money from us, my suggestion is you figure out which of those other people you want to have as investors, and you fit that into the $500,000. We ultimately raised $1.6 million or $1.7 million, something like that, right? So the entrepreneur decided to take a little more dilution because they had a few more people that they wanted to kind of get in at numbers. And I think the first side of it is that they could have said no to our offer, but then most of the money that kind of immediately rushed in probably would have rushed out also, because that money was following our level of interest. So it's under your control, but don't overplay your hand either direction.
Okay, well, we have a final question that was here actually it's been sitting here for 25 minutes, but I figured it was appropriate to save it for last, and that's, I am looking for a VC who likes to wear floral shirts, has long hair, and has a musician for a partner. Do you know anyone who fits the bill?
Brad at Feld.com. Feel free to email me. I'm happy to respond. I hope these Hangouts have been useful, and as I think I said in one of the earlier ones, if there's anything that I can do for any of you, I'll just email me anytime and remind me that you're in this course, but I'm happy to take email and try to be helpful on any front.
Yeah, Brad, thank you so much. I know on behalf of all the students that have reached out to us as well, and just a lot of appreciation for the extent to which you've gone into the forums and really tried to answer people's questions in depth. And if you don't know already and you want to follow Brad's thoughts, you want to be at bfeld on Twitter, and then also we have a few more Hangouts with in fact, we've got a Hangout tomorrow with Startup Pitch coach and instructor Chris Lip, and it will be at noon tomorrow. So check out our Twitter as well and our tweets, and keep following us. And again, Brad, thank you very much.
My pleasure. See y'all.